pretty important for you to understand. I'm get my producer. We're having some technical difficulties. Yes, just to remind you guys, you're on Higher Ground Gospel Radio, and you're in tune to Talking Mortgages. My name is Oral Mclean.
Oh yeah, oh yeah. Wake up every day, working hard, got so much bills to pay, can't see my way, living from pay to pay. Busy trying to make ends meet, no time to go down on my knees to pray, but still God gave me grace. I cannot allow this situation to get me down. No way. So I get up, shake myself and speak into my life. It's gonna be alright. I'm gonna smile. I'm gonna try. To the end I'm gonna fight. I can do all things through Christ. I'm gonna smile. I'm gonna try. To the end I'm gonna fight. I can do all things through Christ. Sons, daughters feeling down, cause daddy's not around.
Okay. All right. I think we have gotten our technical issues sorted out. And for the benefit of those who weren't hearing us, we will just start from the top. Right? As usual, the number for you to send us a text via WhatsApp or give us a call is 825-343-4486. And if you have any question, whether or not it's dealing with our topic, you can still text that question in and we'll be more than happy to answer it. Tonight, we're doing down payment, all you should know. Again, my name is Oral Mclean and I'm the Mortgage MC. And I'm a mortgage broker with the Dominion Lending Centers, and I'm a part of the Mortgage Force team. So we are gonna run right into it because we have a little catching up to do. So down payment, that's the amount of money that you will pay out of pocket when you're buying a property, and it's the difference between what you're getting as a mortgage and what the price of the property is selling for, right? The minimum amount that you can put down is 5%, and that 5%, there's an exception to that minimum, and it's in the case where there's a flex down mortgage that you're getting. And what's a flex down mortgage? That's when you are allowed to borrow your down payment. In that case, however, when you are borrowing your down payment, it is likely that your credit score is over 750 and you have very little debt or zero debt. So those are the cases. So 5% is usually the minimum amount that you pay down, and you can also put up to, in most cases, 20% might be the minimum for some persons, but those are cases that we will go into later and we'll deal with that. But this 5% down is, while it is the norm, there are cases where you have to put more than 5% down and as a minimum. And those cases are when you are buying a property that is over 500,000. So 500,000 or less, 5% is your minimum. If you're buying a property that's over 500,000, we use what we call the sliding scale, where the first 500,000 is 5%, but anything above that 500,000, now you have to add another 5%. So say you're buying a house for 600,000, so 500,000 will be at 5%, and that extra 100,000, that you have to put 10%. All right? So it is still minimum as long as it is below 500,000. And if you're buying a property that's over $999,999, so a million and more, then in that case, 5% is not the minimum, but 20% is the minimum. Right. So, what are sources of down payment? All right. Down payment can come from your personal funds, such as your savings account, your tax-free savings account, your RRSPs. It can come from investment like stocks and bonds and mutual funds, or it can be gifted. And gifted means that you can get this from an immediate family member, such as your mother, your father, brother, or sister. Those are what we consider to be immediate family member. And those funds must be funds that are truly a gift, where you're not compelled to pay it back, right? So all the other sources that we have mentioned, from savings or from investment, we must prove that these funds have been in your possession for more than 90 days, right? So usually we use bank statements. We use the statements from your stock account or your bond account or your mutual funds or your RRSP, your TFSAs, right? We use those statements and we show 90 days to show that those funds have been in your possession for that period. However, in the case of gifted funds, those don't need to be in your possession for 90 days, because as long as you get that gift before the closing of your deal that to buy that property, you are good, right? So that one you don't have to show for 90 days. All right. So what are the implications of putting a down payment that is lower than 20%? Implication is, and this is the major thing, is that if you put less than 20% down, you are compelled to pay what is called mortgage default insurance. And what is mortgage default insurance? Mortgage default insurance is insurance that you pay the premium, but it protects the lender directly protects the lender, and it protects you indirectly, because in case of a default and you are not able to repay your mortgage, knock on wood, what happens is that lender will repossess the property, and then what they'll do is that they'll sell it. If you have mortgage default insurance, what happens is that when they sell that property and it is sold for an amount that is less than what you owe the lender, if you have mortgage default insurance, the mortgage default insurer will then pay the lender whatever is left. If you don't have mortgage default insurance, the lender still can come after you to get the rest of of the monies that you owe, right? So mortgage default insurance protects the lender because they're sure that they'll get whatever shortfall there is from the insurer. It protects you indirectly because it will prevent the lender from coming after you for whatever shortfall there is, and you don't want them to come and then sell whatever other property you have in terms of your car or your furniture, whatever else that you might have, right? So it protects you indirectly, but it protects the lender directly. So one implication of mortgage default insurance, of putting less than 20% down, is that you have to have mortgage default insurance. What happens is that those insurance premiums, or the money that you'll pay for that insurance, is calculated up front and then added to your mortgage, right? So you pay that up front, and when it's added to your mortgage, you basically spread over the life of the mortgage. So if your mortgage is 25 years, you're really paying for it over 25 years, right? Another implication of putting less than 20% down is that because you get mortgage default insurance, your mortgage is now viewed as being less risky, and as a result of that, you usually get get slightly better interest rates than if you had put more than 20% or more down, right? And I know that part can be a little confusing for persons. Say, oh, how come I put less money down and I get better rates? Shouldn't it be when I put more money down I get better rates? But no, remember, the fact of the matter is that the lender is more confident that in case there is a default, they will get all their money back. That gives them the opportunity now to give you better rates, right? Because that is an incentive for you to have your mortgage insured. So if you're less risky, you get better rates. All right, so that's one implication there of putting less than 20% down. All right. What are the major implications of putting 20% down or greater, right? So if you're putting 20% down or greater, what will happen is that you're not compelled, or in most cases, you're not compelled to take mortgage default insurance. That's one. Two is that you're going to be paying slightly higher interest rates because your mortgage is now more risky than a mortgage that has mortgage default insurance. Three, in most cases, you'll get a greater degree of flexibility because the lender now will have a greater degree of flexibility to deal with your mortgage than if there was mortgage default insurance. Because now when there is mortgage default insurance, your mortgage has to go through two steps of approval, one from the lender and the other from the mortgage default insurer. Now there's no mortgage default insurer, so your mortgage now just has to be your mortgage has to now be in line with the policies of the lender and not necessarily the policy of the default insurer. Another implication of putting 20% or greater down is that your repayment amount should, and I say should be slightly less than if you did not put 20% or more down. And why I say should is because sometimes based on the difference in interest rates, it might not work out to be that way. Sometimes. And that is in the minority of the times, not the majority of the time. All right. So when it comes to down payment, there are two programs that are in place from the government to act as incentive to assist home buyers in when they're buying. And those two programs are the Home Buyers Plan and the First Time Home Buyers Incentive. We'll do them one at a time. All right. So just to remind you, our number that you can get in contact with us is 825-343-4486. And you can do that via WhatsApp for those in Canada and in our international audience. And just to note that the mortgage policies and procedures that we go through on this program is geared mainly at the Canadian market. However, there are some things that are common to markets all over the world when they deal with mortgages. However, as I said, what we do is mainly geared to the Canadian market. And I must make that distinction. And at this time, I can tell you, how is it that you can win yourself a gift card from Starbucks if you're a member of the international audience. And also you can win a choice of gift cards from either Starbucks or Timmy's if you're a member of the Canadian audience. And all you have to do is send us a text or call us on our WhatsApp at 825-343-4486. And all you have to do is tell us the word down payment. All right, great. All right, so Home Buyers Plan. What is the Home Buyers Plan? The Home Buyers Plan allows you to take your down payment from your RRSPs. That's your Registered Retirement Savings Plan. It allows you to draw up to $35,000 tax-free. Because thing is, your RRSPs are taken out of your earnings before tax is calculated, right? So if you make withdrawals from your RRSP normally, then what they would do is that they would calculate the taxes that you did not pay, and then they would apply those taxes. However, when you are buying a property and you are using monies from your RRSP to buy that property, especially when you're a first-time home buyer, what the home buyer's plan does for you is that it allows you to draw this money from the RRSP without paying the tax penalty. However, this money that you take from the RRSP to use as your down payment is seen as a loan, right? So you're really taking a loan from yourself, and this is expected that this should be repaid over a certain period of time, and the repayment, you do it at your leisure. It's not like you have a set amount that you have to repay, all right? So you have $35,000 that you can withdraw up to. It's tax-free, and this now can be applied as your down payment. All right. How is it that you are eligible for this money? All right. One, you can withdraw the money from your RRSPs in order to purchase a property for yourself. And this property must be one that you're going to be using as your primary residence. So you cannot withdraw it in order to buy an investment property. No, the program does not cover that. If you're going to withdraw it and you're not using it to buy a property that you're going to be using for your primary residence, but you're going to use this money to buy a property for a relative who has a disability, you are also eligible to do that. All right. So those are the main things for the home buyers plan. Now, for the first-time home buyers incentive, is geared at assisting home buyers in order to reduce the amount of money that they pay for their mortgage repayment amount. And that's a major objective of this. Again, for this one, the government sets it that you can use this when you're buying your first home, or 5 years after you have bought your first home and you're going to buy another one that you're going to use for your primary residence. All right? Some restrictions is that the property that you're buying cannot be more than 4 times your annual household income. That's the main restriction. Can't be more than 4 times your household income. And what happens is that if you're buying a property that is a new build, you can get up to 10% of the amount to add to your down payment after you have already qualified for the loan, right? If you're buying a property that is already existing, you will get 5% to add to that amount, right? So, and you have up to 25 years or the life of the mortgage in order to repay that amount. And your repayment, it cannot be done in parts. This is one of the drawbacks of this program, right? Your repayment cannot be done in parts. It must be done a one-time payment. So it's not like you can pay part 5 years after and then another part another 5 years. No, must be a one-time payment. And what happens is that if you get 10%, when you are gonna be due for repayment. One, if you sell the property before the mortgage has run its life, or when the mortgage has come to a close, or if you try to port your mortgage or sell any portion of the interest in the property, meaning if you are, say, going through a divorce and say you want to keep the property, but your spouse wants to be bought out, if they buy you out, then you have to repay the amount, because what happens is that that mortgage is no longer the same, right? So main attributes of the first time home buyers program: the property can't be more than 4 times your annual income, your annual household income. You have to be a first time home buyer, or the property that you're buying must be bought 5 years after you bought the first property. You must be a Canadian resident or permanent, a Canadian permanent resident or a citizen, or you're authorized to work in Canada. And you must meet, very, very important, you must meet the regular minimum down payment that is of that 5%. So at least you must meet that first 5% without adding the incentive, right? Because you have to qualify for the mortgage before you can get the incentive, right? So you're going to ask, how is it that you can apply for these incentives? All right, so once you have been approved for your mortgage and you have found the property that you want to buy, what you do, there are 2 applications that you must fill out. And I can have the links sent out so that you guys can have it. But there are 2 applications that you fill out. And once you have filled those out, you send those back over to your mortgage broker, which should be me, right? And what happens now, I send it over to the lender, and the lender submits it on your behalf. And once it has been submitted and accepted, then you call there's a number that you call, 1-855-844-4535, and they'll walk you through all the other stuff that you need to do, because then it has to be signed off. Your lawyer has to get a copy of it so that they can use it at closing. And all this will take roughly about 2 weeks or so. So the timing must be good to make sure that everything runs smoothly. Right. So again, the incentive must be repaid in full. That means there should be no partial payment, and that is done after 25 years, which is usually the life of a mortgage, or when the house is sold. So you cannot port the mortgage, meaning that you can move your mortgage from one property to another property to keep the good interest rate that you might have. But if you port the mortgage, the incentive is over, because it must be on that property that you got it for. You can't move it to another property. If you buy out your co-borrower, so if you had somebody on it and you bought them out, or you change the mortgage, or you refinance it, done. All right? So that's it as we in dealing with down payments. And as I said, if you have any questions, just send it over to us. We'd be so happy to answer those. But while I'm waiting on questions to come, I have a tip of the day. So this is our mortgage tip of the day. And the tip is, if you have children and you receive an amount from CRA as Canada Child Benefit payments, these payments can be added to your income depending on the age of the child, right? Can be added to your income, and this now will increase the amount of money that you're able to qualify for. All right, great. So just reminding you that you're listening to Higher Ground Gospel Radio. You're listening to Talking Mortgages. My name is Mclean, and I'm the Mortgage Back. And you can contact us on 825-343-4486. Send us your questions. Remember, we have some gift cards there for both international and Canadian audience. And all you have to do is text us the word down payment.
I got so much bills to pay, can't see my way. Living from pay to pay. Busy trying to make ends meet, no time to go down on my knees to pray. But still God gave me grace. I cannot allow this situation to get me down. No way. So I get up, shake myself and speak into my life. It's gonna be alright. I'm gonna smile. I'm gonna try. To the end I'm gonna fight. I can do all things through Christ. I'm gonna smile. I'm gonna try. To the end I'm gonna fight. I can do all things through Christ. Sun starters feeling down cause daddy's not around. They don't know why. Feel rejected inside. Broken families, broken homes, painful memories like no hope, and you feel like letting go. I know you feel like letting go, but I say don't give up. Press until you see your way through. Your way through. But if the door closes, knock if there's no answer, it's time to move and face the truth. I'm gonna smile. I'm gonna try. To the end I'm gonna fight. I can do all things through Christ. I'm gonna smile. I'm gonna try. To the end I'm gonna fight. I can do all things through Christ.
Okay, welcome back. Welcome back. All right, so it's almost time to wrap up, but as usual, I like to announce that we have two winners, and it is so funny, right? Because our winners are Princess and Diane. Princess Diana. Oh my gosh. So Diane and Princess are our winners for this week. They are the persons that are getting our gift cards. And as usual, guys, just send us a text and tell us what cards you prefer, whether Starbucks or Timmy's, and and supply us with the email address, your email addresses, and we will send over your e-cards promptly. All right. So again, just to wrap up tonight, we looked at down payment. We looked at sources of down payment, and as you know, those can come from your personal funds, from your savings. So like tax-free savings account, RRSPs. It can come from your investment, like your stock account, your bonds, your mutual funds. And of course, it can be gifted. So it can come from your mother, father, brother, or sister. And those funds that are gifted doesn't have to be in your account for 90 days, but all the others, we need to show a 90-day history to show that, yes, they were in your possession for 90 days. Yep. And of course, there are two incentives that goes towards down payment, and that is the home buyers plan and the first-time home buyers incentive. The home buyers plan allows you to withdraw money from your RRSP and to put towards down payment. While the first-time home buyers plan, the government gives you what we consider a loan for either 5 or 10% of the cost of the property. And this money has to be repaid at the end of the mortgage, or if you sell your property. And that's it for down payment. Oh, one last thing is that down payment can come from borrowed funds, but this is what we call a flex down mortgage, where your credit score has to be a 750 and above, and your credit load or your debt burden, your monthly debt burden usually is very, very low or zero for that to work. All right, so this has been Talking Mortgages. My name is Mclean, and I'm the Mortgage MC. We will talk again next week. For now, that's my 2 cents. And we'll walk and talk again next week, and we'll take you on another journey where we look at another interesting topic when it deals with mortgages. Again, this is Higher Ground Gospel Radio. See you soon.
I'm gonna fight. Oh, 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 oh.